Good evening, everyone. Today we're looking at financial reporting, FR, and our topic for today is IAS 23. Our topic for today will be IAS 23, borrowing cost. What's the borrowing cost? Borrowing cost is what we know as finance charge or finance cost or interest charge. Now, normally interest charge should be an expense item, should be expensed in the statement of profit or loss statement. But any borrowing cost, any interest charge that is used for capital expenditure, for capital expenditure, such interest cost or finance cost should be capitalized in line with the expenditure on that capital expenditure. That is why the IFAC, the ISB issued the standard on the borrowing costs to treat how interest should be treated in the financial statement, both in the profit or loss statement and in the statement of financial position. Now, the core principle of this standard, what this standard is actually centered on, is that borrowing costs form part of the cost of qualifying assets if they are directly attributable to its acquisition, construction, or production. That means if any borrowing cost, that is any finance charge that you incurred as sort of for you to acquire a non-current asset, should be capitalized in line with the value of that non-current asset. And if it's in line with construction, maybe you want to construct a particular asset, so that interest, for example, a company wants to construct a particular machine, and the companies obtain loans, and this loan you have to pay interest on the loan. Such interest on that loan should not be expensed in the profit or loss statement, but should be capitalized with the value, the cost of that machinery or for production purpose. Any borrowing cost that relates to a qualifying asset must be capitalized in the cost of that asset. All other borrowing costs should be recognized as an expense in the period in which they are incurred. Why? Any other borrowing cost, maybe any other borrowing cost that you borrowed for running expenses, for recurring expenses, or for operating expenses, that interest on that loan should be expensed in our profit or loss statement. Now, what is the scope of the standard? This standard does not apply to qualifying assets measured at fair value. So the standard does not apply to qualifying assets measured at fair value, mass produced, that is inventory. So any inventory that you produce in mass, in a large quantity, in a repetitive basis. So this standard does not also affect that, does not cover such item. Now let's define some terms according to IAS 23, borrowing costs. What is borrowing cost itself? So borrowing costs are interest or other costs incurred by an entity in connection with the borrowing of funds. Now, when we say other costs, if you want to obtain a loan, you pay some management fee. Such management fees should be form part of the cost of that item or expenditure. So any other cost that is incurred just because for you to obtain that loan to finance that capital expenditure, that cost should also be capitalized in line with the cost of the capital expenditure. They may include interest expense calculated using the effective interest rate method in accordance with IAS 39. So it may also include the effective interest rate calculation, finance charge in respect of finance lease. So any finance charge instead of a finance lease. So it's part of a borrowing cost. Exchange difference of foreign currency borrowings to the extent that they are regarded as an adjustment to interest costs. Now, you have a foreign loan in which you use to finance a particular capital expenditure. That foreign loan, we want to pay back the interest on that foreign loan, and because of the difference in currency, that will be exchange rate. There is exchange rate difference. Now, the difference in exchange rate gain or exchange rate loss in the exchange rate should form part of that cost of that expenditure of that qualifying asset So such a foreign exchange gain or foreign exchange loss in line with an interest cost should not be expensed in our profit or loss statement. A qualifying asset. What is qualifying asset? Qualifying asset is an asset that necessarily takes a substantial period of time to get ready for its intended use or sale. When we say qualifying asset, QA, we are saying they are assets that take substantial period of time before the asset will be put for use. That means the asset will take more than one accounting year, more than a year, 2, 3, or more before the asset is being used for its purpose or its intended usage. Examples include, what are the examples of qualifying assets? The examples include manufacturing plants, power generation facilities. All these are qualifying assets. Intangible assets. So intangible assets that you produced or construct for more, or its usage will be for more than one accounting year, is also a qualifying asset. Investment properties, such as buildings, inventory that requires a substantial period of time to bring them to a sellable condition, such as whiskey. So any inventory that it will take you like 2 years before you can produce it, before you now sell it. So such inventory should also form part of a qualifying asset. But they do not include assets ready for their intended use or sale when acquired. So qualifying asset does not include assets that are ready for their intended use or sale when acquired. For example, you purchase a building, and that building you purchase it in order for you to resell it. Such building does not form part of our qualifying asset. Though building is a qualifying asset, as long as that building was purchased for immediate usage or sale, then that building does not form part of a qualifying asset. Capitalizations of borrowing costs. Now, what do we mean by capitalizing borrowing costs? So let me explain the meaning of capitalizing borrowing costs. This is the recognition of the interest cost and other related costs of borrowing as part of the cost of an asset rather than an expense in the statement of profit or loss. Now, when we say you capitalize borrowing costs, we are saying that interest cost and other related costs on the borrowing should add it to the expenditure on the qualifying asset, not as an expenses in our profit or loss statement. Capitalization. For capitalization, now borrowing costs eligible for capitalization. Borrowing costs that are directly attributable to acquisition, construction, or production is taken to mean those borrowing costs that would have been avoided if the expenditure on the qualifying asset had not been made. All other borrowing costs are recognized as an expense in the period in which they are incurred. Now, there are different borrowings or different ways in which we finance our qualifying assets using loans. Now, let's talk about a fund specifically borrowed to obtain a qualifying asset. Now, you borrow a particular money just for a particular qualifying asset. How we capitalize such borrowing costs? Say a specific loan is taken in order to obtain a qualifying asset. The borrowing costs eligible for capitalization are the actual borrowing costs incurred on that borrowing during the period, less any investment income on temporary investment of those borrowings. Now, when we say borrowing costs, now you borrow a particular loan to fund a particular qualifying asset, and it will take you 5 years to construct that qualifying asset. It means that qualifying asset form part of our borrowing cost, or form part of qualifying asset. The interest on that loan for the 5 years period must be capitalized to the cost of that qualifying asset. Now, remember that normally you borrow the money at the first day of construction, not that you borrow the money every year. You borrow every month, all the money once. That is the practical way of borrowing money to construct a particular qualifying asset. You borrow the money in a particular year, then you now use it to fund the qualifying asset. Now, it should be assumed that the amount of interest that you will pay should be in line with the period of time in which you want to construct that asset. So your interest will be for that 5 years, if the qualifying asset will take you 5 years. Now, and the contractors, they will need the money maybe monthly or yearly. Let's say they need the money monthly, and you borrowed, for example, like 5 million to construct that asset. In a particular month, maybe you borrow the money as of January. In February, they need in January they need 1 million. When you give them 1 million, it remains 4 million. Then what will you do with the remaining 4 million? It's an idle fund. You should be able to, as a financial person or someone that have a financial knowledge, you should be able to utilize an idle fund to yield more income. So it is assumed that the excess of that formula, pending the date that they will need that formula, you go and invest it for the period of time in which they will need that money. So you invest it for like 1 month, then you will keep your money back. When you keep your money back, then you pay, then you reverse it again. That is how you reverse. So that income you obtain for the investment should be subtracted from your borrowing cost. That means what we're saying in essence, that amount to be capitalized now in essence to borrowing cost should be a net of interest cost less the investment income. So let's look at this illustration to explain better. We say on 1st of January 2014, Bondly PSC issued a bond to raise 25 million naira to fund a capital project which will take 3 years to construct. So 3 years to construct. Amounts not yet needed for the project are invested on a temporary basis. During the year to 31st December 2014, Bondly PLC spent 9 million on the project. So he spent 9 million on the project. The cost of servicing the bond was 1,250,000 during the period, and the company was able to earn 780,000 naira through temporary reinvestment of the amount borrowed. Now, very simple. This illustration is so simple. So we are to calculate amount to be capitalized. How much will be capitalized? How much is to be capitalized? Amount to be capitalized is the interest, the servicing cost, which is the interest charge, less any reinvestment income. When you less it, the net is what to be capitalized. So the cost incurred is 9 million. The cost incurred is 9 million, which is amount you capitalize in line with that asset. Is 9 million, which is the cost. Then the interest of that 9 million is 1,250,000. The reinvestment income is 780,000 naira. And when you subtract them, the net is 470,000 naira. And that is your net amount to be capitalized. So when you add it together, the total value is 9,470,000 naira. Now, let's talk about fund used for the purpose of obtaining a qualifying asset. So, if funds are borrowed generally, the amount of borrowing cost eligible for capitalization should be determined by applying a capitalization rate to the expenditure on that asset. That means the interest amount to be capitalized will be the interest rate, which is the interest rate times the amount you incurred, not the amount you borrowed. The amount you incurred. You can borrow 5 million naira and incurred 2 million on that asset. How much you be capitalized is the interest times the 2 million. That's the amount you will be capitalized. B, the capitalization rate should be the weighted average of the borrowing costs applicable to the borrowings of the entity that are outstanding during the period, other than the borrowing made specifically for the purpose of obtaining a qualifying asset. Now we are saying that when you have pool of loans, now you collect money from the pool of loan to finance a qualifying asset. It's not a specific loan. Then how you get the interest rate? You are saying you must look for the weighted average cost or the weighted average capitalization rate or the weighted average rate of that pool of loans. So before the end of this class, you will see the formula for weighted average cost. I explained the formula for weighted average cost. See, the amount of borrowing costs capitalized during a period should not exceed the amount of borrowing costs incurred during that period. How much that you capitalize on borrowing costs on no account will it exceed the amount incurred on that qualifying asset. Because there is no, what I'm saying is that in no circumstances will for amount you capitalize on borrowing costs higher than the expenditure on that borrowing cost. For example, you cannot see whereby you say the amount incurred on the QA is 1 million, while the interest capitalized is 1.5 million. It's not possible. That's why we say the amount to capitalize should not exceed the amount incurred on that borrowing cost. Now, another thing we need to understand where our question might come, if not calculation, is to know when to commence capitalization. When we commence capitalization, at what point we start to capitalize your borrowing cost? Is it at the point in which you incur the now you should know the particular period of time in which you will commence to capitalize your borrowing cost? Is it the time in which you borrow the loan, or is it the period in which you start to incur expenditure on the qualifying asset? So you should know, or is it the time in which the activity goes on the qualifying assets. So capitalization should commence when one, expenditure for the assets are being incurred, when the expenditure on the qualifying assets are being incurred. Two, when borrowing costs are being incurred. So when you incur the borrowing costs, you start to capitalize. 3, activities that are necessary to prepare the asset for its intended use or sale are in progress. So when these 3 When these three scenario are in place, then we can start to capitalize our borrowing cost. Any of the three, it, it might not be the three at the same time. It can be any, as long as we are told in our question that the expenditure for any of these three is in place, then we can capitalize the borrowing cost. Expenditures on a qualifying asset include only the payment of cash, transfer of other assets, the assumption of the interest bearing liability. The activities that are necessary to prepare the asset for its intended use or sales are in progress. What are those activities? You are saying one, the physical construction of the asset. When you see that the physical construction of the asset, maybe they say they want to construct a particular QA, and you actually see the contractor, you see the equipment, they are set for the construction, then we can say the activity to construct the asset has begun. B, the technical and administrative work prior to the commencement of the physical construction, such as activities associated with obtaining permits prior to the commencement of the physical construction construction. Such activities exclude the holding of an asset when no production or development that changes the asset condition is taking place. Suspension of capitalization. When we suspend capitalization should be suspended during extended period in which active development is interrupted. So you have to suspend borrowing costs, capitalization of borrowing costs. When there is a suspension in the active development of the asset, so when there is such situation, we should also suspend capitalization. Capitalization is not normally suspended, so you don't suspend capitalization when during a period when substantial technical and administrative work is being carried out. That means you don't stop borrowing costs when there is a substantial technical and administrative work is being carried on. We are told that there is a minor suspension in technical and administrative work in the qualifying asset. When you say that is minor, when temporary delay is a necessary part of the when a temporary delay is a necessary part of the process of getting an asset ready for its intended use or sale. When there is a temporary delay, delay is part of the process of getting the assets ready for its use. For example, construction of a building, there's always a normal delay. For example, after laying foundation, there will be a particular time before you start to erect mold blocks on the foundation. After you mold blocks you mold the block for the building, there will also be a delay, a normal delay before there will be roofing. So such delay should not suspend capitalization of what or borrowing costs, because if that delay is a necessary part of that construction, so you don't suspend capitalization. Now, cessation of capitalization, when we cease or when you stop to capitalize borrowing costs. Capitalization should cease when substantially all the activities necessarily to prepare the qualifying asset for its intended use or sales are completed. So once all the activity to make that asset for its intended use are completed, then we have to cease to capitalize borrowing costs. So other borrowing costs after that period will be expense. Will be expense. This is normally when the physical construction of the asset is complete, even though routine even though routine administrative work might still continue, or there are minor modifications, such as decoration of a property to purchaser specifications that are outstanding. So when we are told that there is a minor modification, after the building has been completed or the QE has been completed, then the period of minor modification is not part of the period whereby we capitalize our borrowing costs. That means after the building has been completed, and we are told that there will be extra 3 months for minor modification. Those 3 months should not form part of capitalization of borrowing costs, even if there is a administrative work on that QA. The costs that have already been capitalized remain as part of the asset cost, but no additional borrowing costs must be capitalized. What are the disclosures? What are we to disclose? You have to disclose the policy, accounting policy adopted for borrowing costs. What are the policy? You have to disclose the amount of borrowing costs capitalized during the period and the capitalization rate. These are the 3 major things you have to disclose. Disclose the accounting policy, disclose amount capitalized, and disclose the weighted average rate or effective rate. Let's look at illustration 2. On 1st of January 2016, Leganese PLC borrowed 1.5 million naira to finance the production of 2 assets, both of which we expected to take a year to build. So a year. So there is a QA. Work started during 2016. The loan facilities was drawn down and incurred on 1st of January 2016. It means that the loan, you already draw the loan down on that first day of the year, which is the 1st of January 2016. You created the loan, which is 1.5 million, and was utilized as follows, with the remaining fund invested temporarily. Now we are told that for 1 year, the loan is for 1 year. So for asset A and asset B, for asset A, in the first day of the year, which is the 1st of January 2016, 250,000 was incurred, while for B, 500,000 was incurred. For assets A, for 1st of July 2016, 250 and also 500 were incurred for A and B. The loan rate was 9%, and Leganese PLC can invest surplus fund at 7%. At 7%. At 7%. At 7%. At 7%. You are required ignore compounded interest. Calculate the borrowing cost which may be capitalized for each of the assets, and consider consequently the cost of assets of each asset as at 31st of December 2016. So the asset was, that means for asset A, it need 500,000, which is 250 plus 250, 500,000. While for B, it need 1 million to construct. But the way they bring out the money was in 2 phases. Now, our solution now is that you have to calculate the interest cost, because it's for 1 year. Because we said the borrowing is for 1 year, and that means it's 500,000. there will be an interest cost for asset A. Then 500,000 times 9% is 45,000 naira. Why 1 million times 9% is 90,000 naira. And the way they incur it is what they incur 250 in 1st of January. They incur another 250 in 1st of July. From 1st of January to 1st of July is how many months? January to July is 6 months. Now that means they have to incur the surplus for 6 months. That means when they obtain 500,000 for asset A, 1 million for B. They gave the contractor, for example, for 250. It remained 250. The balance of 250 they invest it. Actually, we now have to do the interest rate. It will now be 250,000, which is the balance, the idle fund that will be needed as at 1st of January, as at 1st of July. Times 7%, which is times 6, because that one is not for 1 year, it's for 6 months. So that's 6 over 12. So that will give us the investment income. The same thing we have to do for B, which is 500,000. Then 7% times 6 months. Better we subtract it from the cost. We have 36,250 for A and 17,500 for B. Now for asset A, we want to know the total cost of that asset. The amount incurred for asset A is 500, while for B is 1 million. Then the interest cost that will be capitalized is 36,250 for A, while is 17,500 for B. The total cost is 536,250 and 1,072,500 for B. Now let's look at this illustration 3. Illustration 3 shows us that there is a pool of investment, pool of loans, in which the company take loans to take a fund to finance a particular expenditure from existing loans. And how do we know the particular interest rate? Remember that we are using a particular effective interest rate, and you have 3 different loans existing for the company. You now use part of it to finance a particular PA. Now how do we know the particular interest rate? That is the reason why I give us a formula that we can use to do so. We are told that Chelsea PLC had the following loans in place at the beginning and at the end of 2016. After 1st of January 2016 and 3rd of December 2016, we have 10% bank loan that will expire in 2018. We have 9.5% loan that will expire in 2019, and we have 8.9% loan that will expire in 2016. The 8.5% debenture was issued to fund the construction of a qualifying asset, a piece of mining equipment, construction of which began on 1st of July 2016. Now, we are told that the debenture was obtained for a specific asset. When a loan was obtained for a specific asset, that interest rate will be used to the amount incurred on that QA to calculate our borrowing cost that we capitalized. That means if we want to take loan now, we don't use, if we want to use fund from existing loan, we don't use the value or the loan for a specific asset to form part of the loan or the interest we use to calculate our effective interest rate. On 1st of January 2016, Chelsea PLC began construction of a qualifying asset, a piece of machinery for a hydroelectric plant using existing borrowings. So these existing borrowings. Expenditure drawn down for the construction was 30 million on 1st of January 2016, then 20 million on the 1st of on 1st of October 2016. That means what it is that they 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 spend 30 million in January and they spend 20 million in October. So we have to know the total interest cost on this loan. Now, and they said this amount 30 and 20 was from the existing loan, which is the 10% bank loan and 9.5% bank loan. We are required calculate the borrowing cost that can be capitalized for the hydroelectric plant machine. Calculation of borrowing costs to be capitalized. Now let's look at the first thing. If we are given, the first thing you have to do, we are given a pool of loans, and we are told that so if you are given you form a particular QA from existing loan, we should calculate. Okay, the first thing we calculate is the effective interest rate from the existing borrowing. So let's look at the workings for the effective interest rate. Now, read the formula. Is the effective interest rate or the capitalization rate, or you say the weighted average rate, is a summation of the interest of total interest on each loan over the total loan outstanding times 100%. That means you have to calculate the interest on each loan, and each loan that is existing, then the summation of all the interest times the total outstanding loans, then times 100% will give us the effective interest rate. Or you just say loan RA percent times loan A plus RB percent times loan B. If it's steady loan, then RC percent times loan C. Then that is the interest. Then you add all the loans together, then times 100%. So for our question, we find that we have two existing loans, which is the one of 10% and the one of 9.5%. Then the loan is 10% times 120 million plus 9.5% times 80 million over the summation of both the loan, which is the 80 plus 120. Our effective interest rate is 9.8%. That 9.8% is what we use to capitalize our expenditure on the qualifying asset. Now, what is our expenditure? The first one is at 4th of January. We have 30 million. So it will be the first one, which is 30 million times 9.8%, plus we are told that we also incurred another expenditure on 1st of October 2016, 20 million. Then this will takes 3 months to December. So we have October, November, December. So we have 3 months. So we capitalize this for just 3 months because it was incurred in October, not January. If it's January, say it will be full interest rate, full annual effective rate. But because it's during the year, which is October, then from October to December is 3 months. That's why when I say is 20 million times 9.8% times 3 over 12. Times 3 over 12. So by the total borrowing cost will be 3,430,000. Then the total cost of the asset is now 50 million times 3,430,000 naira. So see you in our next class.